University of Missouri Extension Ag economist Scott Brown is our market analyst this week. On March 29th, the USDA quarterly hogs and pigs report was released. According to the report, the U.S. inventory of all hogs and pigs on March 1st was 72.9 million head. This was 3% higher than a year ago, but 1% lower than last quarter. Meanwhile, hog prices continue to be impacted by the possible rising feed prices, and it recently added 25% tariff on U.S. frozen pork by China. As of April 4th, China has also announced they may impose additional tariffs of 25% on 106 American products, including soybeans, cars, and chemical products. We talked with Scott Tuesday morning about how these issues are impacting pork demand, but we started by asking for a synopsis of the March USDA quarterly hogs and pigs report.
Yeah, Bridget, if you look at what we got out of the report last week, it certainly confirmed that we continue to see expansion in the hog industry. Overall market hog inventory up 3%, talking about now a sow herd at 6.2 million head. Much of the numbers that we got really confirmed what we would have thought pre-release of that USDA report. As we've seen expansion in processing capacity, we've seen hog inventories grow, and this report pretty much came in line with what we anticipated. It just reminds us as we go through the remainder of 2018, we've got a lot of hogs to continue to deal with.
With those percentages, how does that affect the prices of hogs?
Well, I think when you look at where we're at today, two things are at play. Number one, we do have a expanded processing capacity with much of the new facilities that have come on board, and that's actually created more demand for hogs themselves. However, when you look at the other end of that, we also have to sell more pork out the back end of many of those plants, and I think that's where we've seen a struggle a little bit as we've gone through 2018. As pork prices, wholesale pork cutout values been below year-ago levels, things like that. Belly prices has been much weaker than where we were a year ago at this time, and much of that I think has really been attributable to the $15 decline that we've really seen in hog prices here as we've started 2018.
Along with that demand, there's also a possibility of higher feed costs due to the soybean meal prices going up, along with corn, and then the wheat is being affected by the Great Plains drought. How is that going to affect with the demand and everything?
Yeah, well, I think when you look at what's happening to pork producers, the squeeze is getting much tougher as we talk about soybean meal prices that are anywhere from $70 to $80 a ton higher than where we started 2018, and then we've got another 35-40 cents on corn. When you look at the planting intentions report we also got out last week that said we were going to plant 89 million acres of corn, I think that's certainly provided some impetus for higher feed costs. So lower hog prices and higher feed costs, I think, makes it much tougher for producers to see black ink here as we go through 2018. We frankly got ourselves lulled into these very low feed costs staying with us for a long period of time, and it didn't take much in terms of some drought issues in South America as well as planting intentions here in the U.S. to see those feed costs move up, probably adding another $3 to $4 a hundred to the cost of producing pigs today.
And not only with the high feed costs, there's also now just released yesterday, China added a 25% tariff on U.S. frozen pork. What does that mean about our global demand for pork?
Yeah, so I remind us all the time, if we're going to grow these kinds of supplies like we are set up to do here for the next several months, we need all the demand possible, both domestically and internationally. When you take one of your top 5 markets like China has been for our pork for a number of years, you have to be concerned about the effects, and I think the combination of these additional supplies of hogs with the uncertainty related to things that happen as a result of China putting a 25% tariff on frozen pork, it just adds uncertainty and probably puts a lot more pressure on, again, producers' bottom lines here in 2018.
Do you think NAFTA is going to be strong enough to keep that demand still high, or do you think we're going to have quite a bit of a problem?
Yeah, so I think when we started 2018, if you look at U.S. pork exports for January, they were above year earlier levels. There was, frankly, a lot of excitement relative to the concern of perhaps us getting out of NAFTA at some point in time. So we did start the year really well. You just see all of these issues, whether it's a tariff on our pork going to China or some discussion of us still pulling out of NAFTA, that certainly makes us concerned about where these global pork markets go. And with the kinds of increases we have in pork production, 3.5%, 4% this year in 2018, we need to move product outside the United States. I think Mexico can be certainly helpful to us as long as that market stays open here as we go through 2018.
So what should hog producers do due to these current issues and with the hog prices being a bit low?
Yeah, so even though we have a situation where returns have gotten much more stressed here as we've entered 2018, I remind folks all the time, risk management under this scenario may be something that we need to look a lot harder about. I still worry there's more downside risk in hog prices or maybe upside potential in feed costs that we need to be paying attention to and locking in reasonable profitability, if that's possible at this point in time, might be prudent just given the risk for higher feed costs and lower hog prices as we look over the next several weeks.